Welcome to the Deep Dive, your shortcut to being well informed. Today, we're plunging into the latest earnings call from a major player in the insurance brokerage world, really unpicking their recent quarterly performance.
Yeah, it's Q2 2025 we're talking about, and that conference call happened just after hours, July 31st. Management sounded pretty confident about their strategic execution.
They really did. But the market's initial reaction, well, that seemed to tell a slightly different story, didn't it?
A bit of a disconnect there, perhaps.
So our mission for you today is to cut through all that noise. We're going to give you hopefully a clear, concise picture of the financials, what management's focusing on strategically, and those underlying industry trends shaping where this company's heading right now.
Exactly. Can this insurance giant keep delivering with its bold growth by acquisition strategy? Or is the market right to be maybe a little wary of the growing debt and, that slowing organic growth?
Let's unpack it.
Okay.
Let's kick things off with the headline numbers. On a GAAP basis, the standard accounting rules earnings per share came in at $1.40.
Right, $1.40. And that actually missed the consensus estimate, which was $1.67.
Yeah, a noticeable miss. And it wasn't just GAAP, was it?
No, you're right. Adjusted earnings per share also saw a slight miss. It hit $2.33, but the consensus was looking for $2.36.
Okay, so misses on the earnings lines, but the top line, the revenue.
No, that was a different story. Much more positive. Revenue reached $3.22 billion.
Which beat the $3.2 billion consensus.
Exactly. And it represents a really solid 16% increase year over year. Pretty strong growth there.
So what drove that impressive revenue beat then?
Well, a strong 5.4% organic growth was a big part of it. That's, growth from their existing operations, not just bolting on acquisitions.
Right. And commissions looked healthy.
Very healthy. Up 9% year over year to $1.81 billion. And their risk management revenue also climbed 9%, hit $391.8 million. So good underlying performance.
Okay. And profitability. That's always key for brokers.
Oh, yeah. And adjusted EBITDAC. That's a really key measure for brokers, sort of their core operating profit.
Right. Earnings before interest, taxes, depreciation, amortization, and those contingent commissions.
Exactly. That surged 26% year over year to $1.01 billion.
Wow, 26%. That's huge.
It is. And it pushed margins up to 34.5%. That's a 307 basis point expansion.
Over 3 percentage points. Impressive.
Very. And the net earnings margin also improved significantly to 17.3%. This actually marks their 21st consecutive quarter of double-digit EBITDAC growth.
21 quarters. That really does point to a business model that's, incredibly good at leveraging acquisitions for profit, doesn't it?
It certainly suggests a very efficient integration playbook. Helps de-risk that growth for investors, maybe, despite the upfront costs.
So, looking at the surface.
Yeah.
Strong revenue, really impressive margins.
Yeah.
But that earnings per share miss definitely caught the market's attention, led to some immediate pressure. Is that the whole story, though?
Probably not. Let's dig in a bit more.
Okay, let's unpack this and dive deeper into those pivotal financials and what management actually said. So while the company's overall organic growth was 5.4% this quarter, their core brokerage segment specifically posted 5.3% organic growth for Q2.
Right, 5.3%. Now, that followed a really strong 9.5% in Q1.
Yeah, Q1 was huge.
It was, which brings their year-to-date organic growth to 7.6%, still very respectable.
And management's take on that Q2 number?
Well, they really highlighted that this Q2 organic growth was pretty much right in line with what they expected, even with some headwinds they saw, particularly from property renewal premium changes that popped up in June.
Okay, so no panic there.
Yeah.
And looking forward. The full year.
For the full year, they're sticking to their outlook, reiterating mid-single-digit organic growth, specifically targeting the 6.5% to 7.5% range.
So confident they can still hit that.
It seems so. For the second half of the year, they're projecting organic growth around 5% plus for both Q3 and Q4. They did note, though, that their strong Q1 had some positive timing effects that might flip a bit, become a headwind in the back half.
Ah, okay. So some lumpiness expected.
Yeah, and they also mentioned things like lumpy life insurance cases and potential shifts in property and casualty rates could, influence things quarter to quarter.
Right, always moving parts. Now, those organic growth numbers, they look solid, but they're often tied to the broader market, aren't they?
Yeah.
What did management say about pricing? That can really swing things for a broker.
Good question.
Yeah.
They described pricing as rational but disciplined. That was the phrase they used.
Rational but disciplined. Okay. What does that mean in practice?
Well, property renewal rates were actually down 7% overall. That was maybe a couple of points softer than they were seeing earlier in June.
Down 7%. Okay. But other lines?
On the flip side, casualty lines were up 8% overall.
Stronger there.
Yeah. Within casualty, you had general liability up 4%, commercial auto up 7%, and umbrella coverage, that extra layer of protection, saw an 11% increase.
11% on umbrella. Wow. Anything else stand out?
Yeah, interestingly, D&O, that's directors and officers liability, was actually down 3%. Workers' comp was up about a point, and personal lines were up 7%. So quite a mixed picture across different lines.
Definitely. And how's that affecting clients? Is it hitting everyone the same?
No, not at all. It's creating very different experiences. For smaller clients, those generating less than $100,000 of revenue for the broker, their renewal premiums were actually up 3% on average.
Okay. And the larger clients?
For the larger clients, those generating over $100,000, renewal premiums were actually down 2% overall.
Huh. So bigger clients getting a bit of a break, mainly due to property.
Seems like it. Management stressed, though, that if you exclude property insurance from the calculation, then both the small to midsize and the larger accounts are seeing global renewal premium increases, somewhere in the 4% to 6% range.
Got it. So property is the big outlier, dragging down the average for larger clients. What about reinsurance?
Reinsurance pricing was described as flat to modestly higher, still being driven by concerns over losses from previous years, rising loss trends from inflation and the whole litigation environment.
Still tricky then.
Yeah. But they did note that new business indicators, things like audits, endorsements, cancellations, they continue to look positive. No signs yet of a kind of broad global economic downturn impacting them.
That's encouraging. Okay, switching gears to strategy. The absolutely massive news is still that $13.45 billion AssuredPartners acquisition. How's that progressing?
Management reported really excellent progress, actually. They said they are definitely on track to close the deal in Q3 2025.
So next quarter.
Right. And importantly, no material regulatory hurdles expected. They did clarify that, while some of the day-to-day integration work streams were kind of paused because of regulatory rules.
Standard procedure.
Yeah, the senior levels kept talking, kept the planning going. They suggest they're basically ready to hit the ground running the moment that deal closes.
Okay, good to hear. But beyond that mega deal, they haven't stopped acquiring, have they?
Oh, not at all. This company remains highly acquisitive. They did 9 tuck-in deals, those smaller strategic ones, in Q2 alone.
9 in one quarter, while managing the big one.
Yep. Added about $290 million in annualized revenue just from those. And their M&A pipeline is still described as robust.
Meaning?
Around 40 term sheets are either signed or being prepared right now. That represents roughly $500 million in potential annualized revenue.
Wow, so the M&A machine keeps churning.
It really does. Management emphasized their strong machine, as they put it, and they seemed quite proud that they're still on the short list for businesses looking to sell, often family businesses, even with this huge AssuredPartners deal happening.
That reputation as a preferred buyer must be a big advantage.
Huge. Definitely a competitive edge.
They also talked quite a bit about innovation, didn't they? Particularly AI.
They did. Their AI-driven analytics platform, Soar E360, they said it's now embedded in 65% of renewal discussions.
65%. That sounds significant.
It is. And it's not just, tech for tech's sake. By embedding AI like this, they're aiming to automate parts of risk assessment, client matching, which could really cut down broker time per client.
And boost cross-selling, presumably.
Yeah.
Drive those margins even higher.
That's the goal. Drive margin expansion beyond just simple cost cutting. They mentioned their R&D spend is running near 3% of revenue.
Which is quite high for a broker, actually.
It is. Signals they're serious about it. They highlighted some early AI wins, too, particularly in things like claims summarization, policy review, and back-office reconciliations, areas where it can really improve efficiency.
Makes sense. Okay, what about their financial flexibility to actually do all this M&A and investment?
Well, they reported about $14 billion in available cash on hand as of June 30th, and importantly, no outstanding borrowings on their main line of credit.
So plenty of dry powder.
Seems like it. They believe they're in a strong position to fund another $2 billion in M&A this year in 2025, and then approximately $5 billion more in 2026.
And that's without using stock.
That's the plan, yeah. Before using any stock, while still maintaining an investment-grade debt rating.
So that's roughly $7 billion earmarked for M&A over the next, 17 months or so?
Exactly. And they project that could add maybe $600 to $700 million in EBITDAC. They feel they've built this really robust industrial strength core operating system, as they called it.
A chassis, almost.
Yeah, a chassis that can support billions more in revenue with only marginal extra costs. It allows them, they think, to offer higher quality stuff at lower costs, like having a super efficient factory ready for more production lines.
Okay, so management sounds very confident about the strategy, the pipeline, the financials.
Very confident tone, yes. But now, despite that positive outlook on integration and growth, the immediate market reaction was cautious.
Cautious is putting it mildly, maybe. Shares dropped 3.8% after hours, right? Down to $275.02 from about $287 before the call.
They did, and they closed down 4.3% the next trading session. The volume told a story, too. After-hours volume was about 5 times the 30-day average. And weekly options implied volatility spiked 22 percentage points right when the results came out. That signals a pretty significant immediate reassessment by investors. It wasn't just a small dip.
And this reaction, it comes after the stock's already been underperforming quite a bit, right?
Yeah, absolutely. Total returns were negative 10.3% over the last month before the call, negative 13.2% over 3 months, and basically flat, just 0.1% positive over the past year.
All significantly lagging the S&P 500.
Considerably lagging, yeah, especially given the S&P's strong run.
Were there specific worries weighing on the stock even before the call?
Oh, definitely. Pre-call pressure certainly played a role. You had the usual hurricane season loss fears starting to creep in.
Always a factor for insurers and brokers.
Right. Rising reinsurance costs were a concern. And then there was the growing anxiety about the leverage the debt level needed to finance that huge AssuredPartners deal.
Ah, yes, the debt. Ratings agencies noticed that too.
They did. Some agencies placed the company's debt on a watch negative back in mid-July. That definitely added to investor apprehension.
Okay. And the dividend? Any change there?
No, the dividend was held steady at 65 cents per share. Gives it about a 2.2% yield at recent prices. So, the overall feeling from the call, despite management's confidence, it just felt kind of neutral to cautious from the market's perspective. You've got these record margins, but against that EPS miss and this big leverage overhang.
It really seems like this company's doubling down on its roll-up playbook, doesn't it? It's not just buying companies, it's this whole strategic engine.
Absolutely. It's designed to consolidate market share fast, leverage their existing infrastructure, and boost margins quickly through those expense synergies. The AssuredPartners deal is the big one, meant to vault them into that clear number 3 global spot.
And add those middle market strengths. It's a classic bold move for them.
It is. But the skeptics, they're really zeroing in on that pro forma leverage, what the debt level looks like, assuming the deal is done today.
And that's projected to go above 4x EBITDAC. Temporarily, at least.
Mm-hmm. Correct. Temporarily cresting above 4x. And that's a level that, it makes ratings agencies and investors pay close attention. It demands absolutely flawless execution on getting costs down and hitting those cross-sell targets to pay that debt back down.
So the pressure's really on for the integration.
Huge pressure. The sentiment from the buy side, the big institutional investors, it seems pretty mixed. Some are applauding the revenue resilience, the underlying strength.
But others
are flagging what they call deal fatigue risk, basically worrying about what happens if the AssuredPartners integration hits any snags. It's like, you bought the house, but the renovation costs and effort could be more than expected.
And the sell-side analysts who cover the stock, are they aligned?
Not really. Divergent views there, too. Some are keeping their buy ratings, focusing on that great margin story and the long-term vision. But others have actually cut their ratings, citing concerns about executing the integration smoothly and that immediate financial miss.
Okay, so lots of focus on the acquisition. But beyond that, the innovation piece, the AI, that's still a key part of the story.
It is, yeah. That R&D spend near 3% of revenue shows they're serious. And operationally, you just can't ignore the fact that they keep printing these really impressive margins that are better than their larger peers.
Right. Testament to their cost discipline. And they've promised even more margin expansion.
They have. Another 200 basis points for the full year, they said, coming from back office consolidation and automation efforts.
But the market seems stuck wrestling with these mixed signals.
Exactly. You've got record margins, strong M&A on one side, but then you have slowing organic growth, that EPS miss, and this significant leverage from the mega merger on the other side. It's a balancing act.
And the real test is still to come, as those AssuredPartners integration costs actually start showing up in the numbers.
Precisely. And as they have to prove they can bring that leverage down like they say they will.
So looking ahead, what are the key things investors should be watching? The main catalysts?
I think there are three big ones dominating the narrative right now. First, just getting that regulatory clearance and the day one close of AssuredPartners done in Q3, that's a huge hurdle to clear.
Okay, number one is closing the deal.
Number two is the upcoming Q4 renewal season. Specifically watching casualty pricing, could it potentially wobble a bit if loss cost inflation starts to ease off? That could impact organic growth.
Like the pricing environment. And third,
and this is crucial, is what they do with capital return once that leverage starts to come down. Management has hinted share buybacks are likely to resume maybe by mid-2026. That's a big potential positive for shareholders down the line.
got it. So deal closure, Q4 renewals, and capital return plans. Those are the key milestones you'll want to watch closely.
Definitely. They'll tell you a lot about how this story is unfolding.
Okay. And now for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on everything we've heard. So after all that, what's a bold move that might make sense here?
Okay, well, considering the current market skepticism we've talked about, that immediate earnings miss, and all those leverage concerns around AssuredPartners, here's a thought.
All right, let's hear it.
While the stock is clearly under pressure, right, and ratings agencies are being cautious, management is very clearly telegraphing this path to deleveraging. They're aiming for 2.8x EBITDAC within 18 months after the deal closes.
Right, getting back down to a more comfortable level.
Exactly. And they're signaling the likely resumption of share buybacks by mid-2026.
So you're saying despite the near-term negativity in that stock dip, there's a potential long-term angle here. The outrageous part feels like betting on a company facing a major integration challenge with shaky sentiment. Kind of feels like catching a falling knife, maybe?
It does have that element, yes. That's the outrageous part. But the plausible angle is maybe buying some long-dated, out-of-the-money call options.
Okay, long-dated calls. Targeting what kind of time frame and price?
Well, maybe targeting a strike price significantly above where the stock is now. And you'd want an expiry date that coincides with that mid-2026 timeframe they mentioned for buybacks, or maybe even later.
So the bet is that the market is being too pessimistic right now.
Exactly. The trade speculates that the market is over-discounting the integration risk and the leverage concerns. The idea is that the stock will eventually re-rate higher once the AssuredPartners deal is successfully absorbed, those synergies start kicking in, and capital starts flowing back to shareholders through buybacks.
Offering potentially significant upside if, and it's a big if, management executes on that deleveraging and buyback timeline.
Precisely. It's fundamentally a bet on their operational execution and that long-term strategic vision, rather than getting caught up in the immediate quarter-to-quarter noise. Definitely high risk, but potentially high reward if they pull it off.
Interesting. A bet on management's proven playbook, essentially.
In a nutshell, yes.
Okay, so to recap then, this quarter saw strong revenue and margins really fueled by that robust M&A strategy and impressive cost discipline we keep seeing from them.
Right. But the market reacted cautiously, focusing on the earnings per share miss and, the anticipated leverage coming from that huge AssuredPartners acquisition.
The strategic story seems clear, though. Aggressive growth through acquisition, backed up by strong cost control and this emerging focus on AI.
Yeah, the storyline is clear, but the coming quarters are going to be absolutely critical. They need to demonstrate flawless execution, especially with integrating AssuredPartners. They've laid out the plan. Now it's all about delivery.
Well, we hope this deep dive has helped you cut through some of that noise and given you some valuable insights into this earnings call. What really stands out to you after digging into all this?
Lots to think about. And as always, please remember this information is just for educational purposes. It should definitely not be considered financial advice.
Absolutely. Thanks for tuning into the deep dive. We'll be back soon with another breakdown of the market's biggest calls.